Just looking at the reports that are out, we've got Fitch Ratings in a special report published yesterday saying that despite the Kenyan market showing resilience in the wake of a challenging operating environment, and this particularly when it comes to the banking space, Kenyan banks' earnings growth may slow as weaker asset quality leads to rising impairment charges moving forward. Do you share that sentiment that's come to the fore there?
To an extent, yes, but what I think is at the end of the day, we do expect that the banking sector will see a slowdown in the long to medium term, and so this will definitely affect both their asset bases and also their performance. However, I believe that the market is pretty unpredictable, and so I believe that this will not affect their share prices on the market negatively as much.
As I was just discussing with Steve a moment ago, an issue that the CBK has been trying to tackle has been the fact that these banks aren't lowering their own lending rates in tandem with the central banks, and this is really putting them in a vulnerable position with regards to their exposure to non-performing loans. So when do you actually see banks coming to the party here?
That is still highly unlikely. We've rarely seen the banks actually lower their rates, and even when they do lower their rates, you end up with different charges that end up, hidden charges that end up eating into the borrowers, whatever they're lending out. But at the end of the day, what we're looking at right now is the fact that the banks are looking to help spur borrowing as well. They need more borrowing. They can't really go the way of not being on the side of the borrower, because what will happen is if borrowing slows down, then their bottom line does suffer. So what we are looking at now is hoping that they will lower, at least even if it is minimally or marginally, they lower their rates, and even if they don't, they will start to offer products that reach to the mainly unbanked population, because we've seen most of the banks that have done really well are those with a model that that targets the lower end market, and also that targets those people who will have loans that they recycle over and over, maybe 2 or 3 times in a year, which means they're not big loans and they tend to be short-term loans in that.
With that being the case, and with that being the context in which these banks are operating now, should expansion into neighboring countries of East Africa occur as envisaged in your books?
Well, that is exactly what they are doing, actually. The fact that most of the population in East Africa is unbanked. Secondly, because what we are seeing is that the banks are beginning to be actively involved in development issues. So, for example, we are finding that in terms of, say, infrastructure, in terms of, say, those people who are suffering from the drought and everything, whatever money is getting to them is now being channeled through banks, by be it NGOs or the donor community. So banks are actually gaining from the sort of transactions this is generating. But at the same time, it is helping them to reach these people. They've realized that by developing these areas, which are largely undeveloped and unbanked, they're beginning to get so much access to money that they did not have access to, and this is actually helping them to gain on their bottom lines.
What we have seen Fitch do, though, is highlight that capital held at current levels may become inconsistent with the existing rating, suggesting that there's currently downward pressure on the ratings that are currently there. Are you not concerned about some of the ambition these banks have on a regional scale because of the impact it will have on their balance sheets moving forward?
Oh, well, I'm a bit concerned, of course, but I wouldn't really advise them to slow down, because slowing down would mean a negative impact on our economy as a whole. So I think the more people they reach and the more access the people have to banks, the better it is for them in the long run. So I think with a strategic view, when you look at it in the long term, this is actually to the advantage of the region, even though in the short term it may affect the banks negatively.
We heard a while back that we had the Central Bank of Kenya having the ambition to raise the minimal level of capital to 1 billion Kenyan shillings by 2012, and many were seeing that as a positive step. Do you see this changing the structure of the banking system in Kenya?
It will definitely spur a lot of mergers and acquisitions. It will also spur the stock markets, because most of the banks will definitely come to the markets to try and raise the sort of capital they will need to reach the base capitalization. This is actually a good thing, because we need bigger, more capitalized banks, because that enables them to be able to lend more, to be able to participate more, and to reach more, rather than have all these tiny banks, some of which have only one branch, for example. I don't see why we have such banks still in existence.